The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA-registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hey, thanks. Welcome back to the show. I'm your host, Peter Weitz. You're listening to the In Black and Weitz radio program. Make sure you are close to your computer today and send us an email, or feel free to follow us on Twitter at Peter Weitz, or email me, peter@inblackandweitz.com. I think you're going to really find today's guest to be informative, particularly as we talk about where we are in this current cycle in the market, and I'm going to get to him in just a moment. Before I do, I want to get a quick shout out to my friend Michael Rice. His son is home recovering from a very unusual disease, Liam, and I want to wish him a speedy recovery and all the best. So thanks again for Rich Weiss coming on the show last week. We had a really interesting conversation about target date funds and how they fit into your investment matrix. Today we're going to go in a little bit of a different direction. We're going to talk about liquid alternatives. And it's going to be an interesting conversation because I want you all to understand, and our guest is going to talk about that, how this type of investment fits into your investment matrix and how it really is critical when markets are having wild upswings with a potential correction coming. And we're going to talk really in depth about that. But before I do, let me introduce today's guest, Rick Cortez. Rick is co-chief executive officer of Broadmark. He joined them in 2009 in September. He was the president of distribution, but he was appointed as co-CEO this past June, and he continues to be a part of their investment team. He has over 25 years of experience in investment management. Most recently, he spent 8 years as president of the private client group at Torrey Associates based in New York. And prior to that, he was a vice president at Goldman Sachs and product manager for Goldman's external money manager program. Before joining Goldman, he spent 11 years at Prudential as a senior vice president overseeing product development, communication, and sales for the investment management services division. He graduated cum laude from Queens College of the City of New York with a BA. He's been a guest lecturer on investment policy and hedge funds at Wharton and at Harvard, and he was awarded the Certified Investment Management Analyst, the CIMA designation, in '93. He's author of many articles, published very, very often, and I'd like to welcome Rick to the program. Good morning, Rick.
Good morning, Peter. Thank you.
Yeah, my pleasure. So thanks for joining us. Rick's on the West Coast over in lovely San Francisco, and I'm over here on the East Coast, but I really appreciate him waking up early and making sure he's available for us. And I think you're all going to find this a fascinating conversation. But, you know, Rick, I started out a moment ago and I mentioned the term liquid alternatives. And, you know, typically when we talk about alternative investments, and we have on the show in the past, you know, we get into commodities, currencies, you know, sort of the outside of the box stocks and bonds. But you're specific to what you call liquid alternatives. And I was wondering if you could just start out by giving me a little bit of history on the alternative investment, but specifically a definition of what liquid alternatives really are.
Sure. Well, let me start. I will give you a definition, but let me start by saying that the alternative investments, just to start with what alternative investments are vehicles. And generally speaking, in the old days, and the old days being anything before a few years ago, they were hedge funds. That is, strategies where you are able to do a number of things that you cannot do in most investment programs. For instance, use leverage. Most mutual funds, et cetera, do not use leverage, do not borrow money to lever the portfolio. But hedge funds can do that. In addition, there's short selling. That is, it's a tool that a money manager will use to try to make money if the market goes down. Again, historically, most funds, mutual funds, do not use those types of tools. And the other thing that hedge funds had that most other mutual funds did is the way they get paid. Many hedge funds get paid a percentage of the profits, whereas most other money managers get paid a fee. So this realm of hedge funds, alternatives, has been something that has been invested in for many years, but generally speaking, only by the wealthy. For instance, you mentioned that I was at Goldman Sachs, and it's quite a while ago that I worked at Goldman Sachs, but when I went to Goldman, I found that in talking to clients who had $100 million, $200 million and more in their portfolios, the really wealthy people in the United States, most of their portfolios look very different than others, and that is they had hedge funds. They had these money managers who were able to use these new tools or these different tools to manage portfolios. And when I went to Goldman, I said, well, something is going on here. You know, if the wealthy are doing it, and I, by the wealthy, I mean the wealthiest families in the United States, but I also mean the universities, Harvard, Yale, Princeton, Columbia, et cetera, are using, in their endowment funds, they use a lot of these alternative strategies. So I thought, well, if the wealthiest and smartest people in the United States are doing this, why isn't this appropriate for others? And the reason is that leverage, short selling, taking a percentage of the fees, was not allowed by the Securities and Exchange Commission, generally speaking. But as with the financial crisis of 2008 and 2009, many people realized that the old way of doing things, the old way of managing money, buying and holding, not having access to these new tools, was something that was hindering most people. So that's a long-winded way of saying what happened in 2008 and 2009 was that some of these strategies, long, short, the ability to go long, short, using a little bit of leverage, were transferred into the mutual fund realm. So many money managers said, well, if this is able to help you get through bad periods in time, let's use them. And that's when these strategies that were heretofore hedge fund strategies were packaged into mutual funds, which are available, publicly available, open-end to all investors. So a liquid alternatives fund, to get to your question, Peter, is a publicly available investment with daily liquidity. So if you decide you buy it today and you don't like it tomorrow or the next day, you can sell it. So perfectly liquid on a daily basis. It's a mutual fund, just like a Fidelity fund, Vanguard, any of the other big funds that are available and under the scrutiny and the umbrella of the Securities and Exchange Commission under the 1940 Act. But these liquid alternative funds are able to do some things that most buy and hold funds were not able to do, such as short selling and using a bit of leverage. Does that answer your question? I hope.
Yeah, it does. And let me drill down on that just a little bit. So, I think when you go back to this 08, 09 mess, a lot of investors out there heard the term hedge fund and saw these massive losses from hedge funds, either from poor investments, leverage, or all the above. And I think it's an interesting point. I really want you I want to emphasize this, and I want to know if you want to add to it, is that, you're acting in your management capacity as a hedge fund, but yet you're being fully regulated pursuant to, the 1940 Act and, all the rules and regulations of a mutual fund. So you're getting the benefits of a hedge fund without having the risk associated with unregulatory, angles, where other hedge funds in 2008, 2009 were not subject to that regulation.
That's exactly right. And I think as a result of 2008 and 2009, here's what most investors learn there. Number one is, whereas the hedge fund world was illiquid, that is, if you wanted to sell your hedge fund, even if you were a very wealthy investor, it might take you 3 months, 6 months, a year, depending upon what the hedge fund wanted to do. Most people, as the result of 2008, said, when I want my money, I want it tomorrow, or I want it today, if possible. So most people wanted greater liquidity and wanted access to their money. That's number one. Number two is, whereas hedge funds in the old days didn't really tell you what they owned. They were under no obligation to tell you what they owned. Most investors, as a result of the crisis, said, I want to know what I own in the portfolio on a daily basis, number one. And number two is, with respect, if you're using leverage or you're borrowing money, I want to know how much you're borrowing. So I want up-to-date information, and that's called transparency in our business. I want you to tell me exactly what's going on there. And as you say, Peter, regulation. I think if you again, 5 years, 6 years ago, if you read Forbes magazine or Fortune magazine and they referred to a hedge fund, they'd refer to them as unregulated pools of capital. And I don't know about you, but I don't like the idea of my money being in an unregulated pool of capital.
No, I mean, I could essentially have started a hedge fund sitting in my living room.
That's exactly right. Anybody could, and you just get the the exemption for as long as you follow the rules not to register. But most people want to be registered, and I think it's a good idea for you as an investor to make sure that that there are certain rules and regulations and requirements that the money manager who's managing your sacred money, the money that you've saved up, are required to do. So that's as you said before. What's happened is they are registered under the Securities and Exchange Act of 1940. And the other thing is, and I don't know if your listeners are that familiar with this, but if you had a hedge fund, which is generally a limited partnership, at tax time, generally speaking, most of them are late getting their tax returns to you, or that they're what's called K-1s. They're the tax reporting things. Mutual funds are required by law to get you your reports on time, so that you can, by April 15th, you can file your taxes. And that's an advantage of mutual funds over limited partnerships. So for those reasons, the liquidity, transparency, regulation, tax reporting, mutual funds, in my estimation, are all superior for most of us investors in a general sense for investing, and particularly for fiduciaries. That is somebody who's responsible for this money in an IRA, in a trust fund, in a foundation, an endowment. It's good, number one, to have daily liquidity. It's good to know exactly what's in the portfolio and be under the regulation of the government. So
interesting. And what I want to talk about in just a minute, and I really want to get into this, is there's a whole level of risk that people think they take on by going into these hedge funds that have these, crazy levels of return. And I want to get an understanding from you, or a better understanding for our listeners, of how hedge funds, or your strategy that is, quote, hedge fund related, can actually mitigate risk and lower your overall risk portfolio. And we're going to do that in just a minute. You're listening to the In Black and Weitz radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. We're joined today by Rick Cortez, the co-CEO of Broadmark Funds. And Rick was giving us a brief history of how hedge funds collapsed in the 2008-2009 markets, but yet investors realized that that style of investing is important. And Rick has been able to put together some mutual funds that act and walk and talk like a hedge fund. And one of the things that, if you listen to the show regularly, you know that we believe heavily that the endowment method, the Harvard and Yale method of investing, is the best way to diversify your portfolio, maximize the potential for growth, but mitigate the most risk. And that's by adding the third leg of the stool, being alternative investments to your portfolio. I was hoping, Rick, you could comment on how alternative investments can actually lower the risk of your portfolio when there's a perception in the market that they're deemed to be really risky investments.
Well, right, Peter. I mean, again, going back many, many years, most people looked at hedge funds and thought they were very, very risky investments, and some of them were. Some of the early hedge fund managers, George Soros back in the old days, took big, big, big bets. And they either won or they lost, and if they won, they became billionaires, and if they didn't, you never heard about them again. However, the whole idea of a hedged portfolio is to make sure that you don't lose a lot of money. It is to hedge, and that's the reason they're called hedge funds, to hedge the risk of the portfolio. The original concept is that you buy the stocks, for instance, in a long-short portfolio, you buy the stocks that you think will go up, and you sell short the stocks you think are not good companies. And by doing that, you are hedging your risk. Most money managers in the United States buy stocks for the long run, buy and hold, because in the long run, stocks have gone up and hopefully will go up in the future. However, another way of doing it is to make sure that you don't lose money. And here's the philosophy behind many of these liquid alternative strategies. If you constrain your downside, you don't lose, let's say, more than 10% over time. No mean trick, but if you are able to have a portfolio strategy which limits downside risk to 10%, you only have to capture 1/3 of the upside to match the market. So instead of, whereas most money managers are trying to hit home runs and trying to really make a lot of money on the upside, the hedge fund strategy, the liquid alternative strategy, is exactly opposite. It says, don't hit home runs, just don't lose money. And in the long run, all you have to do is capture a little bit of the upside, and you're able to do well. The advantage of this for your listeners and for we as investors is that you have two different approaches to the market, and when you put them together, they're loosely correlated or not correlated at all. When the market goes up, those money managers you have, which are long stocks, which are buying great companies, that will do very, very well. But when the market goes down, as it did in 2008 and 2009, the hedge strategies or liquid alternative strategies will constrain your downside risk. So even though one part of those long managers will go down, these other hedge strategies should protect you from loss. And remember, one of the things I said that these strategies can do that most others don't is sell short stocks. And that is, it at least gives you the ability not only to protect your portfolio, but perhaps even to make some money in a down market. So in putting these two together, I think that is a prudent strategy for most of us. I mean, remember, if you're invested in mutual funds or in stocks, traditional stocks, the S&P 500, and the market gets hit again as it did 5-6 years ago and goes down 50%, you're talking about a 50% loss in your portfolio. And for us baby boomers, for fiduciaries, for endowments, foundations, a 50% loss is absolutely devastating. And that's not something that we can allow to happen. How do you avoid that? One of the answers is to have a liquid alternative strategy, which at least the strategy is able to mitigate downside risk during those periods of stress in the market. And the bottom line is that's what liquid alternatives are designed to do, many of the liquid alternative offerings.
It's so interesting, and you made it a point, and I just want to emphasize it again because we do talk about this a lot on our show. But when you talk about drawdowns in the market, I think there's misperception of how math actually works. And you mentioned about a 10% drawdown. Well, if you have a 10% drawdown, that means you don't have to make 10% to get your money back to where it was. You have to actually make more. And the math works. If you had $100 and you lost 10%, you have 90. If you make 10%, you only have 99. And so there's this amazing misperception with regards to how devastating, as you mentioned, drawdowns in the market really are. And I think that that's an interesting point.
Oh, you're absolutely right, Peter. Just to comment on that, just to amplify that, the mathematics, and it's really arithmetic. If you lose 50%, the market was down in 2008 to 2009. It was down 50%. How much do you have to make to get even? It's not 50%. It's 100%. You've got to double your money. That's no mean trick. Now, it has happened over the last 5 years, and in the long run, as Jeremy Siegel of the Wharton School have said, stocks have gone up in the long run. The problem is that each individual is different, and if I'm 70 years old or 75 years old, and my portfolio gets hit with a 20, 30, 50% decline, hopefully I'll have plenty of time to make it up, but maybe I won't, or how am I going to make it up if I'm on a pension or I'm not working anymore? So this becomes extremely important the older the investor is, or depending upon the investor's circumstance. So the mathematics works against you the older you are, or the closer you are to retirement, in trying to make up those funds that you lose just from an arithmetic point of view.
Yeah, and even more important is, I don't know of, if you have this 50% drawdown, I don't know of any investor that's going to be 100% invested in the S&P 500 to capture that 100% upside. I just don't think it's realistic.
That's right. And psychology being what it is, unfortunately, most people do tend to be influenced by what's going on in the market. And I know during 2008 and 9, many people said, well, I know I should hold on. I know I should keep my stocks. But the fact is, I don't know what's going on here. And I have to sleep at night. So they sell out, and they sell out just at the time they probably should be buying. And one of the problems now after a 5-year run in the market is that many people might be saying now, well, I know I shouldn't invest after the market has gone up for 5 years straight, but I can't stay out. I have to participate, and that may not be the best thing to do at this point in the market cycle.
Right, and I think that's interesting. So let's move on a little bit. Let me ask this question. So you have several portfolios that you manage on behalf of my clients, and what are some of the typical investments that you would make in a liquid alternatives portfolio?
Right. Well, let me refer only to our portfolio for the moment, because there are a number of different ways that liquid alternatives are available. So I'll tell you what Broadmark does. We invest only in the major market indexes, and we do so through ETFs, through futures contracts. So our primary investments are not in individual stocks. So we take no individual stock risk. So that if something happens with BP in the Gulf, that might affect a portion of the portfolio in an index, but it doesn't affect us, at least in a direct sense of owning the security of BP. So we buy the Dow Jones Industrials, the S&P 500, the small cap stocks to the Russell 2000. We might buy emerging markets in an index, but we only invest in the broad market indexes. And part of the reason we do that is if you invest in the S&P 500 ETF or futures contract, you're really investing in 500 stocks. So you are diversifying your portfolio. So our portfolios generally are of market indexes. We may own one, so we may own the S&P 500, or we may own a combination of large cap stocks, small cap stocks, international, technology, et cetera. So those are our investments. But perhaps what makes us a liquid alternatives manager is the tactical approach that we employ, and that is, the philosophy is, do not be invested all the time. There are points in the market cycle, in the economic cycle, where you should be more invested in stocks, and there are other points where you should perhaps not be invested in stocks, and in fact protecting yourself from a downturn in the economy and in a downturn in the stock market. So we use a number of economic factors and momentum factors to try to gear where we are in the economic cycle, and we would regulate our exposure to these market indexes by deciding where we are in the market cycle. So that's, generally speaking, how we manage those portfolios.
And that's interesting. And I like the strategy of having or buying ETFs from a liquidity perspective. So if you feel in your management that you need to make a tactical shift based on what's going on in the market, it's very simple to rearrange the portfolio and tilt it to meet exactly what you feel is working or not working in the marketplace.
Right. ETFs and futures contracts are among the most liquid investments anywhere. I'm an ex-bond guy, so I used to trade treasuries, U.S. treasuries, and that is the most liquid market on earth. But ETFs and futures are among the most liquid available to an investor. So you can buy large amounts of them and sell large amounts of them without disturbing the market, and that's really important when your philosophy, as ours is that unfortunately in the world we live in, anything can happen at any time. And if something adverse happens, whether it's over in the Middle East, whether it's in the Ukraine, whether it's in China or Japan or here in the United States, if something adverse were to happen, our philosophy is that if it's something that we really don't know what the outcome is, the most prudent thing to do is move to the sidelines. You don't always have to be right. You don't always have to know what the next step is. Sometimes the wise thing to do is step aside. And that's why liquidity is very important, and that's why our investments are generally ETFs and futures in the most liquid contracts.
And that's interesting. And we're going to take a quick break. When we get back, Rick, I want to get your opinion on where you think we are in the current market cycle. And then I'm actually going to hit you with a question that I don't know if you're going to be prepared for, but I know you're going to know the answer. We're going to take a quick break. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the show. I'm joined today by Rick Cortez, the co-CEO of Broadmark Funds, and we've been talking about the use of liquid alternatives as an integral part of your investment matrix. And I think Rick's made it pretty clear about how the power of these investments reduce the overall exposure to the downside of your portfolio, and yet do help to create upside. And that's specifically emphasized in that the multi-billion-dollar endowments of these colleges and universities use this as a strategy, so we as retail investors should be doing the same. Prior to the break, and I mentioned that I wanted to talk about with Rick where we are in the cycle of this current bull market, but I also I think Rick made a very important comment to me at the break, and I think this is going to fascinate all the listeners. But in 2008, their fund was actually made money. And I don't know if you can run around the country and talk to money managers and find anybody that really made money in 2008. But I think, as Rick mentioned, those two kind of tie together. And I think it's important to discuss both simultaneously. So, Rick, where are we in the current market cycle, and how exactly did you make money in 2008?
Right. Well, we have, our philosophy is this. As I said before, Peter, the first thing to determine is where are you in the market cycle, because all markets go through cycles. They, some are short, some are long. But generally speaking, economies go through contractions and up moves when things get better. And going back to 2008, where were we then in 2007, 2008? Well, let's take a look at that. From a valuation point of view in 2007, price-earnings multiples were around 20 to 22 times earnings. It's not terribly high, certainly not as high as it was during the dot-com days, but still pretty elevated. But more importantly, in 2007 and 2008, just before the market went down, we saw interest rates rising. In fact, the Fed had increased rates 14 times between 2004 and 2007. So the Fed was certainly taking money out of the system. And if you remember back in 2007, everybody was happy. The market had been going up and there's euphoria. All of those things generally come before some sort of correction in the market. I don't think any of us saw the terrible crisis that we lived through in 2008, 2009 from a financial point of view. Nonetheless, the warning signs were there, and we felt that we're coming to the end of a cycle, and it would be prudent in 2007 to 2008 to raise some cash, to move to the sidelines, and perhaps if the market starts downward, to try to take advantage of that. So the answer to your question, Peter, about 2008 is trying to be in sync with the market cycle. And that allowed us to be able to, again, move to the sidelines and be very cautious. And as events developed in 2008 with General Motors, with AIG, with Lehman Brothers, Bear Stearns, it just became apparent to us that this was not a time to have a full amount of your money in the stock market. So that's the way we were able to a bit sidestep and protect our clients' portfolios during 2008 to 2009. So to get to your question, where are we now? We're in a somewhat similar position. The market has been going up now since the 2009 bottom for 5 years. Who knows? I mean, nobody knows the future. It could go up another 5 years straight. Who knows? But we do have valuations rising. They're not at terribly high levels yet, but they are similar to where they were in 2007. The difference is this. Monetary policy, whereas in 2007-8 was tightening, right now we see the Fed tapering, that is, beginning to cut back on their purchases of treasuries, but they're not yet tightening. Interest rates are relatively low and continuing moderate, and credit spreads are low, which means there's no credit crisis. So there's a big difference between now and 2007, which makes us more optimistic, quite frankly, right now, that we're not in for that kind of terrible experience that we had in 2008, 2009. The other thing that's a little bit different is you don't find people euphoric about the market. You don't find people saying, oh, I've got to be in the market, I've got to be in the market. Now, maybe these things are to come, and maybe, as the market goes up, or if it goes up, we'll see those things. But right now, yes, we are indeed, after a 5-year run in the market, one would be tempted to say the market has to correct. But our models right now show that we're not quite there yet. At least we don't think we're there yet, enough to really cut back as we did in 2007 and 2008.
So when you cut back in 2007 and 8, did you go to cash, or was there some other place where you found value?
No, our risk management system, we have a very, very disciplined and specific risk management system, and that is we follow the market. We look at volume trends in and out of the market. What we try to do is we gauge the institutional investor who makes up 70 to 80% of the market. I mean, the market doesn't go anywhere without the institutions fueling it. So we try to get a gauge or get a handle on what the institutional investor is doing. And if the institutional investors are taking money out of the market, we follow up volume, down volume every day. If we see that volume is coming out of the market, there is institutional liquidation of stocks, as there was in 2007, 2008, we begin reducing those positions. I mentioned we use market indexes, ETFs and futures. We begin reducing that and our risk management system is to put the money into cash or treasury bills. Generally speaking, where we're allowed to, we'll always own treasury bills. They're not paying a lot by any means, but the idea here is not to make money on the cash. It is really to protect the portfolio and to use cash as a protection because, as you say, we talked before, Peter, about the mathematics. If you're able to own cash and the market goes down 20%, you're able to redeploy that cash 20% lower, and that's a very, very good thing. It's a very powerful thing. So even though you're not making a lot of money on cash, you do have that as a reserve to potentially make money when the market turns around. So we do use cash, and where we can, we use treasury bills or a money market fund to be able to gain a little bit extra. But right now, with interest rates so low, you really don't make a lot more on buying a treasury bill, a 3-month treasury bill, than you do in holding cash.
No, that's true. And you have two really core holdings, a tactical growth fund and what you're calling a tactical plus fund. Did those holdings, either of those holdings, have exposure to the bond market, or are they primarily the equity markets?
No, we're primarily equity market driven. The securities that we own, as I say, are ETFs and futures contracts. And generally speaking, they are equity U.S. stocks, and we are able to go into international markets. We also are able to buy bonds. We're able to diversify the portfolio a little bit. For instance, if we really were to see problems throughout the world and in the economy, we might decrease the holdings of the U.S. equities. But if there was a flight to quality, we might be able to take a position in the bond market. But generally speaking, that is more for protection, and we do have a limit. We cannot go more than 10%, at least in our core portfolios. We can't go more than 10% in any particular sector of the market. So bonds would only be up to 10% of the portfolio. So it's largely equity driven. Our goal is, over time, if we're able to do our job right, we're able to try to gain. Our goal is to make equity-like returns, as if you were holding the S&P 500, but with our tactical approach to be able to mitigate the downside risk. So less volatility in the portfolio, but trying to aim for the returns that you get by buying and holding the S&P 500.
Got it. And when we come back from the break, I want to get a handle on where you are today inside your portfolios, and have just to see where you stand. And then I have a little bit of a different question. As you were a bond trader, I just want to get your gauge on where we are in this interest rate cycle, and what you think is going to happen in the future, because that is a question that comes up quite often. But we're going to take a quick break. You're listening to the In Black and Weitz radio program on the Voice America Business Network.
Voice America Business Network, the bottom line in business.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled Weitz. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. Again, I'm joined by Rick Cortez from Broadmark Funds, and we were talking before the break about where we are in this market cycle and some of the similarities, but yet some of the differences between now and what was going on in 2007. And there's obviously a much healthier aspect to today's bull run than there was in 07. But generally speaking, I mean, how bullish are you still on this market?
Well, we obviously I can't disclose any of the holdings of the portfolio or exactly what we're doing, but I would just say we do believe this is different than 2007, at least so far or so. Whereas in 2007, 2008, we did hold a great deal of cash and we're cutting back. Right now, we're still reasonably optimistic that the market is in an uptrend, and we don't yet see the signs that where a big decline is imminent, at least at this point. Peter, there are two things that happen prior to more significant declines in the market, and this is going back in stock market history. One is that often you see the large capitalization stocks, the big stocks in the Dow Jones Industrials, the S&P, going up, masking weakness in the rest of the market, masking weakness in the smaller cap stocks, weakness in the mid-cap area, weakness in technology or financials or utilities or transports, etc. We're beginning to see a little about that. If you remember over the last few months, the S&P and Dow have been doing a bit better than the NASDAQ, the Russell. So we're beginning to see signs of that, but right now we're monitoring it. But in addition, the second thing that we've seen prior to more vulnerable markets is the Federal Reserve Board taking money from the system. That is, tightening of monetary policy, raising of interest rates, cutting back on those purchases that are doing now. And so we're seeing a little bit of that. We're beginning to see the Fed taper. But this, until we see interest rates go up, until we see credit spreads start widening, right now, this is a very different time than it was back, 5-6 years ago. So right now, we are invested, and we do hold cash. But we're not in the position that we were back in 2007. All of that can change, of course, if interest rates go up, credit spreads start tightening, if the market gets to levels that are, valuation is very high, but we don't think we're quite there yet.
And what is your opinion on interest rates?
That's a good question. Where you maybe
because we all have one, Rick, and so far we've all been wrong.
That's it. I'm an ex-bond guy, so I look at the long-term trend of rates, and there's a tendency to say when interest rates are so low as they are now, they've got to go up, right? But how many of us have been saying that for 2 years, 3 years, 5 years? Even 10 years. I mean, we've been saying that interest rates are so low they have to go up to more normal levels. I'm not so sure. There's a worldwide deflationary, atmosphere here, with the Fed here putting money into the system. This Thursday, Mario Draghi of the ECB, he said we're going to address this issue, so there's likely be cut in the rates and perhaps even a negative rate so that it will not pay banks to hold money overnight. They'll have a negative. They'll have to pay money to hold reserves, and the whole point there would be to get money back into the system. And we're seeing in Japan, we're seeing monetary stimulus. So worldwide, we're seeing moves to stem deflation, not inflation. And this could be with us for quite a while. So I would not say that because interest rates are very, very low now, they have to move to quote-unquote more normal levels of 4 or 5%. It could happen. But right now, we don't see the signs that that's happening. In fact, we see the real risk in the markets right now, and particularly in Europe, is continued deflation or an actual deflation rather, and trying to get prices starting moving on the upside. We haven't been able successfully to do that. So I would not. Our own view is that interest rates are low, and until we see signs of inflation and tightening by the monetary authorities, we'll likely, continue to see interest rates at these kind of moderate or low levels.
And do you feel that that's contributed at all to this great bull run? I mean, because there's really nowhere to find value in the bond market.
I think that's true. I mean, I think that the fact that most of us, when we look at stocks and bonds, and we're getting 0.3% on Treasury bills, and we're getting only 2.5% by lending the government money for 10 years. You're getting 2.5% on your money. That's pretty low.
Yeah, why bother?
Why bother? So, and in the long run, again, quoting, our friend Jeremy Siegel of the Wharton School, in the long run, stocks have returned 10%, 8 to 10%. Nobody knows what next year or the year after is going to be, but given a 2.5% 10-year Treasury and the potential of U.S. stocks and the fact that U.S. stocks are going up, I think most people, are in a way forced to reallocate money towards stocks from bonds, and that has certainly played a part. I think the ease of monetary policy has played a part in the market's rise over the last few years.
Yeah, and I think as dividend-producing stocks continue to, pay, I mean, it's certainly a great alternative to, your argument of the Treasury paying 2% for 10 years.
Right. Now, the thing, as I said before, what could throw a monkey wrench into that, of course, is interest rates going up, because interest rates going up would make stocks less attractive, and also siphon money away from the money that has been going into the stock market and towards the bond market, because the bond market would consequently be more attractive if, lured by the higher interest rates. So that's a real possibility. And of course, the Federal Reserve Board, some of the members of the Fed have talked about, potential increases in rates, but we'll just have to see. I mean,
right.
Nobody knows the future. Our philosophy is you watch what's going on. The markets are smarter than all of us. Anybody who's been in this, in this business for a long time knows you try to outsmart the market, you'll get your head handed to you. So ours is a very, I think, prudent approach of watching the markets and trying to gauge our exposure to the markets based upon what we see today. Tomorrow may be a completely different story, but our goal is to be in sync with the market cycle. And if you can be a little more invested when stocks are cheap and a little less invested when stocks are expensive, and translate that into a tactical approach, in our opinion, that's, we call it winning by not losing. You just make sure you don't lose a lot of money, and since the market does go up over time, you only have to capture a small part of the market's up move to be able, in the long run, to come out pretty well.
Yeah, and if you listen to the show, you'll know that we run an advertisement on this program. And we finish our advertisement by saying we win by not losing. And that's certainly a philosophy that I believe extensively in, because I would much rather have to recover from a small drawdown than have to really double down my bets to get back to where I was.
Yeah, I think that's true, and I think as I said earlier in the program, I think it's extremely important for those of us who are baby boomers, for those of us who are fiduciaries, for those of us who have endowments, foundations, trust funds, because the volatility of the market is low right now. But historically, as we all know, volatility can come very, very quickly, and once that happens, the markets become very vulnerable. And if that happens at a point in your life or in your career when you just can't afford that, you need something to be able to mitigate the risk in a portfolio. And that's to get back to what we've been talking about for the last during the show for the last hour. Liquid alternatives are something I think that people should look at, not to make a ton of money in the market. What they're designed to do is mitigate the downside risk. And many people might have short memories and may say, well, I don't need that now because the market's going up. But I can tell you the time to take a look at these downside protection type funds, liquid alternatives, is just when you think you don't need them, because a good investor should be diversified at all times, and particularly try to be, again, I said this is the third time I've said it, but try to be in sync with the market cycle. And if you do so, I think you'd be able to maybe not hit home runs in the market, but certainly be able to mitigate that downside risk, and that's a really important thing in this world. So.
And Rick, I really appreciate that, but more importantly, I really appreciate your insight on today's program. Again, it's Rick Cortez, Broadmark Funds, forwardfunds.com, and is that the correct address, Rick?
That's right. Yes.
Yeah, forwardfunds.com. You can learn more about the actual management that Rick does, and his Tactical Growth Mutual Fund, and Tactical Plus Mutual Fund, and how that alternative piece works into your program. Again, Rick, thanks so much for being on the show. I found this to be fascinating just because my interests in investing are certainly aligned with yours, and I can't thank you enough.
Thank you, Peter.
Yeah, great. Next week on the program, we're actually going to talk a little bit about real estate and the recovery of the real estate market and how that's impacting the typical investing community. But again, thanks to Rick Cortez, Broadmark Funds, again, forwardfunds.com. Make sure you check out my blog. I'll be posting today's program. And if you have any questions for Rick, feel free to email me at peter@inblackandweitz. I'll make sure I pass him along and get an answer to you in just a moment or in just a few minutes, because he'll respond quickly. Anyway, thanks again to Rick Cortez. You've been listening to the In Black and Weitz radio program on the Voice America Business Network. Make it a great week.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.